Hey guys, Rick and Michael from Heirloom Wealth Management here to talk about what the heck we mean when we say alternatives. So, those of you that are clients, we talk a lot about this. We've got stocks, we've got bonds, and we've got alternatives. And alternatives are really the thing that have made us different than any other firm out there. We've been using them forever. Very, very useful. 22, it's now 23, but in 22 when everything went down, if you have alternatives in your portfolio, you do pretty well. So, Mike, it's a big topic, and I know you love to talk about this. I'm smiling because if any of you have been with us when we do talk about alternatives, this is one of Mike's favorite topics. So we'll try to keep this to 4 minutes. But Mike, when you think alternatives in the sense of heirloom, what would you say in a nutshell, what we call alternative?
Yeah, I think the important thing for alternatives for our clients, the way that we position it in portfolios, is there's two important things that we want to achieve by incorporating alternatives. One is to increase long-term potential return, and the other is to reduce risk. It's kind of like if you remember the old Miller Lite commercials, great taste, great taste, less filling. That's kind of what alternatives bring to the portfolio: more return, less risk. And in practice, what we've seen over the long term is that's exactly what they delivered. The important thing about alternatives is that they really don't fit into traditional stock or bond categories. And they're not correlated from a return standpoint. And so what's happening in the stock market or the bond market is not necessarily going to influence or even to give you any idea what's happening with the alternative investment portion of the portfolio. Now, when we think about all three of these categories independently, we feel good about their long-term prospective returns looking forward. But the good and the bad times are not going to come at the same time. And what that does is it reduces the risk that any one portion of the portfolio performing poorly causes a large loss for the entire portfolio. And one last thing that I'd highlight about this is that when we think about why that's important is because gains and losses are disproportionately impactful on your ability to compound wealth. If you have a 50% loss in your portfolio, which we've seen plenty of near 50% losses in the stock market, on average, you have a bear market, which is a decline of 20% or more, about every 4 years. And when that occurs, the average decline is about 35%. And so, that can really interrupt your ability to compound your capital over time. If you have a 100% gain, that gets erased by a 50% loss. And so the better we can diversify within asset classes and across asset classes, we don't lose returns that each asset class generates. We just smooth out the ride, which I think is a win-win for our clients. And
examples of what would be alternatives is trend following.
Trend following, and we'll put out a separate video on trend following, but it's an excellent example of an investment that has zero correlation to stocks or bonds, making it an ideal diversifier to what we already own in the stock and bond categories, generating very strong returns. Last year, plus 59%. Stocks and bonds are both down double digits.
Wouldn't that be nice?
Yeah.
It was nice.
and there will be years where stocks and bonds do well and that does not do well. And that's just part of being well diversified. But for our clients versus what we're seeing a lot of our competitors do in the alternative space, I think we're bringing true value because unfortunately, a lot of alternative investments out there are highly correlated to what investors already own. The fees within them are way too high for them to be able to add any value. And typically they're just what I would describe as watered down beta. And without getting too far into the weeds, it's just a low volatility version of stocks and bonds. And so they're not really adding any value is what I'm getting at. I think our clients are reaping the benefits of having a truly third asset class, stocks, bonds, alternatives. At a high level, that's what alternatives are. That's what they're intended to do.
Inside of alternatives, it can be 6 or 7 more asset classes, though. We'll call it alternatives in the fact that it's not going to be correlated. Third time we've mentioned that word, to stocks and bonds. So a 1 would be 100% correlated, do the exact same thing. A -1 would do the exact opposite thing. The sweet spot for alternatives is really 0.
Yeah, I mean,
Doesn't matter.
we wouldn't want to incorporate an investment that hypothetically has a long-term negative correlation to what we own if what we think we own is going to go up in value over time. But if we can find something that is at a 0 correlation, meaning what happens within that investment strategy or asset category is correlated. It's not moving along with the stocks and bonds, has a positive expected return. That's, the great taste, less filling aspect to alternative investments to make them incredibly attractive if you can find good ones.
Yeah. All right, guys. That's alternatives. We'll do another video on trend following in a little bit. But I'm Rick. That's Michael. We're Heirloom Wealth Management. Subscribe below. We'll talk soon. Hey, guys. If you like that, click here or here to see other videos that we've recorded. And we'll see you soon.